Hi there. Thanks for stopping by the Equity Trust virtual classroom. My name is John Bowens, and in this segment, we're going to talk about this mysterious 5-year seasoning period associated with a Roth IRA. The 5-year seasoning period is where you have to wait 5 years and attain the age of 59 and a half before you can start taking tax and penalty-free withdrawals from your Roth IRA. Now, this 5-year seasoning period is specific to Roth accounts, Roth IRAs, as well as Roth 401ks in some instances. So when you have a Roth IRA and you make a contribution, the seasoning period starts January 1 in the year in which you make your first dollar contribution. So let me give you an example of how this works. Let's say we have someone at the age of, let's call it 40 years old, and they make a contribution to a Roth IRA in the amount of $6,000. They have to attain the age of 59 and a half, and the account has to season for 5 years before they can start taking tax and penalty-free withdrawals. So by the time they're the age of 59 and a half, they would have already met that 5-year seasoning period. Where this really comes into play is for those that are getting close to the age of 59 and a half or are over the age of 59 and a half. So for example, let's say we have a 60-year-old that has never had a Roth IRA before in their life, and they set up a Roth IRA and they make a contribution, we're going to say up to the amount of $7,000. So they have a $7,000 contribution going into the Roth IRA. They've never had a Roth IRA before in their life. They're 60 years old. They're going to have to wait until they're 65 years old before they can start taking tax and penalty-free withdrawals from the earnings or from the growth on that Roth IRA. Now, whatever amount they contributed to the Roth IRA, in this case, $7,000, that principal amount can be withdrawn at any time, tax and penalty free, but any growth above and beyond the $7,000 must stay in there for 5 years. Even though they're 59 and a half or older, it has to season for 5 years. And remember, that seasoning period starts in the year in which that person made the first dollar contribution. Now, let me pause there for a moment and clarify. That's the first time they make a contribution to their first Roth IRA, which means if you have a Roth IRA with another financial institution and it's already seasoned, and then you decide you want to open up a Roth IRA, for example, with Equity Trust and make a contribution, you're already seasoned because the Roth IRA seasoning started with the other financial institution. That's an important one. A lot of people miss that. So now that you understand the difference between 5-year seasoning period for somebody that is well under 59 and a half and for somebody that's over 59 and a half, the last item to mention is this 5-year seasoning period also applies to amounts that are converted from a traditional IRA to a Roth IRA. So there's this technique called a Roth conversion where you take money from a tax-deferred traditional IRA and you pay the taxes and you convert it over into a Roth. Whatever amount you convert over into your Roth, that specific amount has to season on its own for 5 years. And you also, as we talked about, have to attain the age of 59 and a half in order to take tax and penalty-free withdrawals. So quick example for you, let's say we have $100,000 in a traditional IRA, and we have $100,000 in our Roth IRA that, let's say, is already seasoned, and let's assume we're at the age of 60, so we're over 59 and a half. So we convert the traditional money into the Roth, getting us $200,000. The $100,000 that's already seasoned, we can withdraw at any time, tax and penalty free. But the additional $100,000 that we convert into the account, we're going to have to wait 5 years before we start taking tax and penalty free withdrawals. Now, I've been saying tax and penalty free withdrawals. What happens if you take money out too early? You're going to pay ordinary income taxes on your growth and a 10% premature withdrawal penalty. So there could be a significant penalty if you take money out prior to the 5 years and the 59 and a half. Last but not least, I should also mention, because this is a common question, while you're waiting for the 5-year seasoning period, you can still use that money for investments. So whether it's stocks, bonds, and mutual funds, or maybe you're an Equity Trust client and you're investing in alternative assets like real estate, rentals, rehabs, wholesaling, maybe private company investments or gold and silver or cryptocurrency. or one of the other alternative investment options. Regardless, you have to keep it in there, yes, for 5 years, but you can continue to invest that money into those either alternative investments, or if you're somebody that's just investing in traditional stocks, bonds, and mutual funds, you can do that as well. And you just have to keep all of the assets in there for 5 years before you start taking money out in order to avoid the penalties and taxes. I hope you enjoyed this training on the 5-year seasoning period applied to Roth accounts. I'm John Bowens here in the Equity Trust virtual studio. Until the next training, keep leveraging compounding interest in the absence of taxation.